Okay, welcome everyone. We'll start our second lesson on Unit 4 is on financial management, accounting techniques for managers. So my name is Anjum Sarkar. If you have any question, please drop email anjum@uk. Hello, can you hear me? Okay, we'll start. Lesson 2, what we're supposed to learn today will be LO2, learning outcome 2, be able to assess business organization performance. So today lesson will be focused on business organization performance, how we can assess business organization performance. So business organization performance. What is meant by performance? What is performance? So performance. When we measure the performance, we always measure the performance in terms of time, cost, and quality. Okay, so in terms of performance, so whenever you measure the performance in terms of cost, in quality, okay, so whenever we'll measure the performance, we measure the performance in terms of time, cost, and quality. So financial ratios measure the cost, measure the time, but not the quality. So we need to look around. We need to make sure we look around the limitation of ratio. We'll discuss as well. Working capital, so we'll discuss what is meant by working capital. Working capital is mean the running capital, which is mean the short-term asset. Short-term assets, which is known as current asset. Those carry on changing within a year, so we call short-term. So today lesson we'll discuss about bank trade receivable, trade payables, inventories, and we'll go through the working capital ratios and all these calculations. We'll discuss about just in time, what is meant by, and the role of just in time in organization process as well. So our discussion will be focused on these. These are the keywords, inductive contents, which we're supposed to learn during this lesson. Hello. Okay, so we'll discuss this, and then we'll go through some ratio analysis as well, and we'll discuss during this. So assessment criteria, assess criteria, analyze the component of working capital, explain how business organization effectively manage the working capital and use ratios to measure the performance of the business organization and evaluate the usefulness of these ratios. So in evaluate, we can look around how these ratios are useful or not, and we'll discuss about some limitation of these financial ratios as well, which we can evaluate. Anybody, any question? Any question? So if any questions, just please drop me in the chat box a bit, carry on chatting. If you can't hear me, and I'll carry on chatting you due to the sound issues. Okay, so now before starting our today lesson, so we'll go through a bit, recap what we learned during lesson one. During lesson, we discuss about understand the financial management accounting system. We discuss different accounting system, and can you hear me? Hello? Hello? Okay, so we'll go through the learning outcome one. We discuss about compare management and financial accounting system. There we discuss financial accounting system, analyze the management and financial accounting techniques to record, and we discuss evaluate, and we discuss about stakeholders. So last lesson we discuss about their output, information, data, and we mentioned a bit ratios. We discussed the legal requirement in a financial accounting, no, not a legal requirement in terms of management accounting. We discuss about legal requirement, tax requirement, internal control. We discuss about double entry bookkeeping. We discuss about bookkeeping, trial balance. We discuss how many types of financial statement. We discuss public limited, private limited, and different sort of the company those use these. Okay, so we'll discuss these all further control system in one of further our lessons as well. So which I'll carry on including these in our discussion as well. We discuss about cash flow. We discuss about investment appraisal as well. I mentioned you different investment appraisal methods, NPV, net present value method, PV, present value method, and sensitivity analysis. Hello, can you hear me?
Yes.
So, okay, brilliant. Okay, so now it's fine. Huh? So,
yeah, now it's fine.
Okay, great. So, welcome. We'll discuss, more in details. a question later on end of lesson as well. Please keep it. If anything, just carry on chatting beside, chat box. And last lesson we discuss about understand financial and management systems. If anything, please ask me. We can go through, and I'll go through a bit, recap on lesson one later on as well. And stakeholders we discuss. And today's lesson will focus on LO2. LO2 is a learning outcome 2, where we're supposed to learn about the bank and the cash balances, trade receivable and debtors. What is meant by debtors? Debtors is also known as trade receivable, and why we have a trade receivable. If we have a credit sales, we have a receivable. So trade payable, it means your credit supplier. When we are purchasing something on credit, we call creditors, and we're supposed to pay money. These are our liability, and that is our asset, is our receivable. So inventory is stock. Stock, normally we have 3 types of stock: raw material, finished goods, and work in progress inventory. Stock can be 3 types. So we'll manage our working capital. Capital means the running capital in the business. Is very important to manage our day in, day out, our activities, where we can manage our cash. Cash management is very crucial because it's the lifeblood for any business, which we'll go through, and we'll discuss all these, different types of ratios, and we'll calculate your actual companies by looking the financial statements as well. Any question?
So far,
Anybody?
no.
Any? Okay. So today lesson to all these assessment criteria, and okay, let's all discuss what do we know about working capital. Any thought about working capital?
Working capital means, as I can understand, is the money that is like rotating for the business. You invest the money for something that you can play on it.
Well done, great. Working capital is the running capital, which is carry on changing day in, day out activities of the business. Like receivable, we carry on selling goods on credit, is a credit sales, and we have to manage. If we have too many debtors, what will be happen? Because a lot of bad debts, people can't afford it to pay. If we'll give without checking their affordability, they will pay us back without using the credit reference agency, without getting the guarantee from the banks or various other institutions. So it means we're giving them credit without any possibility we'll get the money back in year future. So the business manager will make sure it's not made by in our sales, by we need to be manage our sales as well, not all the credit sales, because end of the day we need a cash, and we have to pay cash to our workers because we need to pay the salaries, we need to manage other activities of business. Okay. Yeah. Do we know how many types of financial statement we prepare in accounts?
I can see like one is debit and a credit and maybe cash.
Debit credit is a rule where we call double entry bookkeeping. In accounts, we have 2 entries. Every entry have 2 effects. One is a debit, one is a credit. So like we bought a furniture. Furniture is coming in the business, but I guess when we bought a business, either we can buy a furniture on credit, or we can buy furniture by paying cash. So cash also asset. So furniture is asset which is increasing, and the cash which is decreasing if we are purchasing cash. So we purchase furniture, double entry bookkeeping. So debit will be furniture which is coming in the business. Let's assume this was £500, and what's going out of the business, because we are paying cash 500. So 500 will be debit and 500 will be credit. And all these transactions will be, we can balance in our ledger, and then we can make that from all ledgers to trial balance in accounts. If you're a bookkeeper and you're keeping the record, you're supposed to be record. systematically in ledgers by rule of debit and credit. Especially in militaries, normally they don't have double entry bookkeeping. They use the single entry bookkeeping system. The reason is behind because they don't want to show where these things came from. So some on security reason we can say, but normally in all private organization we use double entry bookkeeping because we can track. So furniture, where we bought it, if the money is reduced, the cash is reduced, where the cash went, we can see, do we have a furniture in our warehouse? If we have a furniture in our warehouse, where we bought it, how much we bought it, all we can check by using the double entry bookkeeping. And we're supposed to have invoices in place as well. From trial balance we'll make the final accounts, which if you're accountant, you're supposed to prepare the final account from the trial balance. And first statement, financial statement, first statement we prepared is called profit and loss. Now we also call statement of comprehensive income, or we call income statement as well. So three names will carry on using: profit and loss, also known as income statement or statement of comprehensive income. Second statement, which shows all the income and expenses in the profit and loss, as the name indicates. And the second statement is called statement of financial position of the company, which is also known as a balance sheet. It shows our assets, it shows our liabilities, it shows our capital. Capital is mean our investment in the business. So asset, liabilities, and capital. If we want to see any company, we can open statement. We can look their statement is called financial position, which is also known as a balance sheet. Any question?
Yeah, balance sheet. Balance sheet is like it is not like mathematics side, or it is just a normal terms, right? If you say balance sheet.
Yes. So
P&L means more in going to the accounting, but balance sheet means it is like everywhere that they can use it, right?
Yes. So balance mean, if I have an asset in my business, I should have something is liability or capital. Yes. Yeah. So my left hand side in math rule equation, like we'll say in math equation, always equal. Yes. Both sides, if we balance our equations. Yes.
Yeah.
So our asset and credit is our liabilities and capital. So which I'll show you some financial statements as well. Any question? So that's the balance sheet.
Okay, no, it's fine. I get clear now.
If you want to see how much company have a plant, machineries, properties, different types of assets, all we can find in the balance sheet. If we want to know how much money they owe it, how much they have, you want to invest it, you want to make sure your money is secure in the company. So they have a lot of liability. Maybe they can't afford it. Company can be collapsed, can be liquidated.
Yeah.
Okay. Third statement we call statement of cash flow. The cash flows financial statement shows how much money in and out of the business. So we can find inflow and outflow from the business. How much money came in? This is very crucial because we have asset, we have a liability. Because asset can be everything on credit. We borrow everything from the bank and we have asset. Asset not a guarantee this company will sustain, because the asset can be against the liabilities. Because maybe we don't have a lot of our own capital. So that's why it's crucial to look around the cash position. If the company has the cash and it's mean company sound cash position will help us. It mean less liquidity problem. So statement of change in equity, last statement, this shows how many shares and how much dividend we paid. Dividend is mean return on investment, return on shares. So which we use the word dividend.
Means so it's not going to be returned to the investor. The dividend, it will not going to be returned to the investor, so like a liability.
dividend is mean how much dividend will percent penny. Dividend, like you deposit money in a bank and the bank give you interest. Yes, if you invest in the company and you buy a share of limited company, they will pay you end of the year is the dividend.
Okay.
Dividend is called return on investment.
Return on investment, yeah.
Okay, so next now, so these are the 4 statements we discussed.
Yeah.
So profit and loss, balance sheet, cash flow, and statement of change in equity, which is also known as shareholder statement, shows how many shares and dividend. Okay, so next now, what is meant by working capital? Working capital available conducting day-to-day operation of an organization, normally the excess of current asset over the current liabilities. Current. So asset need to be, what's come under current asset? First of all, we need to know. Cash is current asset.
Current asset means whatever the things that you have around you, which generate the revenue for the business.
Yes. So
which you can utilize, and from there you can get the revenue.
Yes, revenue. The word revenue have 3 different meaning: revenue, sales, and turnover.
Turnover, yeah.
Is the same thing. Revenue, sales, and turnover is the same thing, no difference. It can be cash sales, it can be credit sales.
That's it.
Credit sales. So that can be our revenue. But revenue not meant by the cash.
Yeah, not only the cash, yeah.
Revenue is not a profit. So we'll say revenue minus cost of sales. Cost of sales in how much we bought it. And then we get gross profit. Then we minus other overhead expenses, or we call other expenses. Like end of the year, we are paying accountant fees and will equal to profit, or we call net profit.
Net profit, yeah, that's true.
So that's, when we're looking the asset, what is the definition of asset?
Asset means the thing that you have for the business.
Yes, so anything you own it, like building, plant, machinery, cash, jewelry, whatever, is your asset.
Yeah.
Education is your asset. Asset is mean anything you own it, anything has the economics value. Economics value mean you can do business with it, you can sell it, you can buy something against it. Like education is an asset, you can sell your services, you can get the money. So that is asset. If the jewelry is an asset, you can give jewelry, you can get cash, or you can do business with it. Building, plant, infrastructure, goodwill of the company, all your asset. Because anything you own it, anything has a value. If I have a chair, those chairs are broken, I can't use it, is a lot of rubbish in my warehouse. So that's not come under the definition of asset. Maybe I need to spend the money to destroy them. Yes, rid of them, especially in developed countries. Yes, where recycling really expensive. So maybe we need to pay the money. So that is not come under the definition of asset. I have a Windows 98 CDs. Lot of CDs are waste. Who's going to buy Windows 98 now?
Now no one will buy.
No one will buy. So when I bought it, I wrote in my book of account, I have an inventory, stock, Windows 98, CD is 1 million. But because asset mean you own it, has the economics value. No, that 1 million is not a 1 million. Yes, because no one is buying it. No one will buy from me. Maybe if it buy, someone really want Windows 98, will buy in pennies. So that's not a 1 million anymore. So I need to revalue my inventories, stock.
Yeah.
So that's why so current assets mean the asset which carry on changing in a year: cash, receivable, inventory, and payable. Also come under the overdraft. Overdraft is always for short period of time. That's come under the current asset as well. So these are all current assets. So working capital management is the management all both current asset and liability. The asset and liability.
Okay.
And in the asset is you own. What about liability?
Liability is the things that is like already generating the what seem like a revenue that I can see. Like I take it from someone that I'm paying the money for, like maybe loan.
Yes. So asset it you own it.
Yeah,
You
asset is I already bought.
You're an owner of it, and in liabilities you owe it.
Okay.
Yes, it's a legal obligation. By law, you have to pay. It's a legal obligation. You're obliged to pay. So working capital management is the management of all aspects of both current asset and current liability to minimize the risk of solvency while insolvency while the maximizing the return on asset. So we need to be managed. So what we need to manage: inventory, receivable, cash, and bank. That's come under current asset. Come under liabilities, payables, bank overdraft. So these are our payables. So current asset, what do you think? Current asset should be more than the current liability. More than current liability. Our current asset need to be more than current liability. Because that's why your credit worthiness, you're a good, you're a strong company. If you have more current asset, less current liability go through. Current asset are the major financial position statement items, especially significant smaller form of working capital. If we don't manage it, we need to balance it. Yes, we good balance it. Current assets are sufficient liquid to minimize the risk of insolvents. Insolvent, we can be bankrupt. Yes, we can be liquidate. We not meet our current obligations. So investing in the less liquid asset in order to maximize return. Investing in less liquid asset in order to maximize return. So we need to be make sure invest in this asset. And we look now managing working capital. Can manage working capital. So make up working capital inventories, stock. What do you think? Can we buy as much we want?
No, for sure we have to manage the stock. If you didn't manage the stock, it might gonna be loss for you, because maybe the things that you bought, it is gonna be expired soon. So it is gonna be loss for you. For sure you have to manage the stock.
Good. And we have to manage the stock. So stock is in inventory is also called stock. Stock all come under the current asset. So always we look at the stock. So if we have a too much stock, what is the problem?
If you have too much stock, means the money is gonna be freeze. The one current asset that you have, it is gonna be freeze, because you cannot buy for something if there is something urgent that you cannot purchase on it, because the one that you bought is already, like, your money is gonna be mismanagement.
Yeah. So current asset is inventory. Inventory need to be inventory. It's the least liquid because inventory can be outdated. We have a lot of so we need to be minimum. That's why they use the approach is called just in time. You only buy the stock what you need it. Don't store, because a lot of storage, like even in our cultures, to lot of things, we buy in bulk. Yes, we saying no problem, but actually you're blocking your resources because maybe a lot of opportunity you're missing it. So your cash is tidy in the inventory. So we need to make sure in the real world as well. So we not have a lot of stock.
Yeah.
So inventory we need to manage. To draw the safety level. Yes.
Yeah.
Not if we have a tool stock, maybe we have and 6.10. So we call even buffer stock. We always need to look around ordering time.
Yeah.
Ordering time. Yes. How long will it take? So we use the term EOQ, economics order quantity. Economics order quantity. We need to look around how much we'll order and how much is suitable for us.
It is same like a par level, right?
Yes, so we need to look around how much is annual demand we have of the goods, how long will it take from supplier to our warehouse, what discount we'll get, what is the holding cost of it, because when you put in a saving the stock in the warehouse, it's costing you every day. Holding cost. So we need to look around all and the stock management. So that's the inventory. Then receivable. If we have too much, what is the problem? Bad debts, yes?
And difficult to stock.
Bad debts, because a lot of money can be stuck in our receivable, because ultimately always we need to look around receivable days. How many days? Receivable days can be between 8. Do you think are lower, receivable days or payable days? So my receivable days 30 days, my payable days how much is we can? The payable days,
yes, 60 maybe.
60 days. You need more than that, because you need to be receive the money quicker and you pay later. You need a good negotiation skills we need to improve, so we can negotiate with the supplier that we want 60 days, 90 days credit. So we have a in between. If our customer won't pay us, at least we have a safety net. We are safe because we have a cash. Otherwise, we can be out of the cash and we need to go to the bank. If we don't have arrangement in place, we can collapse as a company.
Yes, that's true.
So we need to look around the cash. Make a decision about the sources of finance is the best use of the funding, working capital requirement. So decision about whether to choose short term or the long term option depend upon the number of factors. Current assets normally is a fluctuating. Maybe you have permanent, which takes keeping 20% your receivable of your total sales. Yes, permanently, but we need to make short-term finance the attitudes of the management risk the same way in the long-term investment. So we need to look around. We need to measure the risk. What risk we have. Can return. Normally we say higher the risk. We'll say higher the risk, higher the return. But how much risk we can bear as a company? If we don't have a cash, we can collapse. So we need to look around the risk which we are able to. There is no ideal funding package. 3 approaches. We can look around aggressive. Can go aggressive financing. Most current assets include the permanent one, short-term finance. Risky but profitable. Conservative, long-term. We can look around the bank loan, 5-year, 10-year loan. That won't come under the current asset, that come non-current liability. That's the long term.
Yeah.
Bank loan normally not short term. Our draft for short period of time. So we need to make sure. Sometime we have too much money in our. If we have too much cash in our account, that's not good as well.
But if you have too much money, it goes to your income statement, right? So it is good for you.
No, basically you have if you have anybody heard about opportunity cost? If you're keeping too much cash, you have opportunity to get return on it. We can compound it. Yes, we can multiply, compound interest. Because if you have a money in the bank account, bank not give you interest in the current account. Because no doubt you need the cash, but you don't need enough cash. If you have millions of dollars or pound in your locker or in your, actually you're missing the opportunity because you can multiply it, the money. You can buy the other company shares, you can invest in other company's project where you can multiply your money. Yes, so we need to make sure we have a sound, I mean, not too much, not too little. Does it make sense of it?
Yeah.
So capitalization, inventory, receivable, cash is few account payable. There will be our investment in the, we're not supposed to be our investment as well. Yes, we need to be working capital, running capital. We need one balance in it. Yes, normally we say £2 worth of our asset, £2 worth of current assets, and £1 worth of current liability. But it varies in industries. It's not in hard and fast rule. But a lot of analysts say this: if you have £2 this, you have £1 this. But if you have this £4, yes.
If you have,
so it means you have a lot of spare assets. No point. Yes.
Yeah.
Because there's no doubt you're a very less risky company, but what you're not recycle your cash, because cash not going out, cash not coming in. So it means
it is gonna be like a fraud.
You can invest in different projects. You can buy a new machine, you can buy a new car. Yes, which you can offer new services to.
Yeah, that's true.
Then
like money is frozen, like
makes money. So we need to look around how well we manage.
Yeah.
So our trading. Can we trade as much we want?
No, overtrading is maybe if we trade more than you cannot manage, it is going to be problem also. So the one you can manage, still there only you have to make a trade.
Yeah, so we need to look around the trade which we can manage. We need to look around the demand. We need to look around the supply. We need to balance it. Yes, how much we can manage as a company. So our trading, we can say no problem. You buy, no pay in 20 years. Everyone is happy to buy it because don't know what will be happen 20 years time.
Yeah, for sure. There is a new technology, and there is like maybe we'll get the cheaper, the asset will get the cheaper.
Yes, because that can be outdated because the new technology will replace it. So no point, our trading, we need to be balancing. We not our trade because the likelihood of thriving business, effective and efficient management of working capital is essential to maintain the control on it. Because our trading, you can sell it lot of, but you're selling credit, and what will be happen? A lot of bad debts ultimately is create a problem of liquidity as well.
Yeah.
So we need to make sure we have good balance it. So like recently, not recently, no, few months is United Airline. They our booking. So they throw the one doctor out of the plane and not ever take even the seat because they have a past trend, the 5% people to the seats last minute. So this time 5% doesn't cancel. So what will be happen? They didn't cancel. So what happened update? Ultimately, no, you have a 5% booking. So you need arrangement in place. If this will happen, you give them accommodation. Maybe you can adjust them in the next flight. So not, due to this, when the video went to social media, on social media, ultimately the company shares went down straight away by 10% its value. That the company lose good more than 20 million in term of dollars. So we need to look around because that's, our trading is not a good. It can create a problem because we can maybe impact on our brand image as well.
Yes.
Okay, so we need to look around the cash operating cycle, how long the cash going in and coming out of the business. So when you buy it and you sell it, how long it takes you to convert into the cash? Yes, all this you need to be. You purchase something, you have inventory days, and then you have a receivable days, and then you have a cash operating cycle, how long that cash is staying in the cycle complete. So always we need to look around the working capital cycle as well. So that's which we'll go through in detail formula as well. So just in time, Japanese approach, just in time is a pull system of production. So actual orders provide signal when the products should be manufactured. Demand pull enable firms to produce only what is required. So like Dell computer,
Yeah.
laptop, they have assembling in India, and they're taking order from all over the world and they're delivering in 21 days throughout the world. So they use the direct business model. So ultimately they are cutting the middleman cost, and ultimately they are producing in the low cost area, and ultimately they are saving. So just in time. So according to the Japanese approach, which you use initially by Toyota, you take the order of the cars in advance, you book it, new models, and you deliver in few months, take the cash advance, whatever, even you take the down payment. Yes, ultimately the cash flow will come, ultimately we will be well off. And we don't need to overstock it. So all the concept bring the efficiencies in the system. Any question?
So far, no question. Here I can say like a lead time also, right? For the things that I buy from the place like that I purchase, then till they delivered, it is I can say lead time also, right?
Yes. So lead time, maybe we learn about lean manufacturing.
Okay.
Lean manufacturing, cutting the waste also. So we just want to make efficient as much we can. We can't use to our system. It now is a possible because we have electronic data interchange. We can track it, we can order, we can minimize because the cost through this and we can use just in time system now because of the technology, due to the fast communication channel and transport. So that's we need to. The next course is advantage and disadvantage of just in time. Sometimes can be little stock, maybe we not fulfill ultimately, but that's why we need some safety level can be in place. You need a good relationship with your supplier, and you have a multiple suppliers in place as well, and you have a good transport system. If not, that create a problem as well.
Yeah. And you can set your part level as well. Like you can update your part level as per the season too.
Sure, because otherwise it can create a problem.
Yeah.
Next now we're looking our area this will be now is financial ratios. Financial ratios are the useful indicator of the firm performance. measure the performance. Financial ratios, always we divide into the 4 areas, and is ratios compare the benchmark industry to industry. Ratios we can divide into 4 categories: profitability ratios, liquidity ratios, use of resources, which is also known as efficiency ratios, and financial position ratios. So what says this? These are the ratios all being here. So ratios, profitability, gross profit, net profit ratios, we can again say how much we have. Liquidity ratio is current asset divided by current liabilities, current ratios, quick ratios, all we use. All the formula copy at the end, and all the formulas we need to use to calculate the ratios. Yes, all be operating profit margin, sales, return on capital employed. Main thing, we need to use the formula, we need to interpret. The manager we not accountant, but we are managers to interpret the information and how we can use it decision making. Yes, we need. Any question here?
So far, no.
Okay, so next I'll send you these handouts as well, which will go through few ratios now.
Okay.
So So 4 types of ratios: profitability ratio, liquidity ratios, use of and gearing ratio. Gearing mean if you drive in a high gear, what are the chances?
That means you are investing more.
Yes. So when we'll drive in a high gear, there is a risk of there is a risk.
Yeah.
There is a risk of accident. Yes, need to make sure between debt and equity, which will be. So formulas, I'll send you this sheet. Yes.
Okay.
So we have a profitability ratio. What is the formula there? Gross profit
divided by sales. 100.
So we can write the company A, or compare the 2 companies, or we can say company A, we can say 2018 and 2019. We can compare 2 years. Yes.
Like to like.
Yes, like to like we can. And if we look this question, so we look at the gross profit ratios. So this question we have, suppose we have a 2 company. In the same way, we can see the actual company statements as well, which we can go through. We have a 16,200. What is a 16,200? Is a gross profit.
Yeah, gross profit. Yeah.
So gross profit 16,200. So you just need to use the formulas. Yes, 16,200 divided by gross profit divided by revenue. Revenue means sales. Yes.
6,000. Yeah. Total 36.
Divided by 36,000.
Yeah, 36,000 times
Basically
100.
36 million. So just divide it. Yes, ignore 3 zeros at the top, and times by 100. Yes. So gross profit is came for Anika Limited is 45%. Yes.
Yeah, 45%.
16,200 divided by 36,000 and times by 100. Anything we need in percentage, we times by 100. Yes.
By 100. Yeah.
So that's
Okay.
hello. Yes.
Yeah.
So,
I can get that.
So Paprika is 52.5. So if I'll compare with the Nika and Paprika, whatever, so that's 45%, that's 52%. So 52% is better than 45%, yes?
Yeah.
So it means Paprika is earning more, they have a more gross profit, yes?
Yeah.
Because they have less cost of. So this is the 40 to 52%. It means that cost them 48%, yes? Because
Yeah.
everything is
48.
100%. So
Calculated by
that,
100%. Yeah.
so we can look around when we'll go through the operating profit ratios. If we look now, operating profit ratios, what is operating profit? Profit from operation,
Yeah.
32, we can say 3240 divided by
36,000
36,000
times 100.
times 100. So our profit is, operating profit is 9%.
Yeah, 9%.
So my gross profit was 40%, sorry, 45%, and my
45%.
operating profit is 9%. So 36% I have a overhead expense,
Yeah. But this
which is
operating profit is, we can say, EBITDA also, right? It is the same terms of EBITDA, or it is different?
sorry, it's
The
the same.
profit from operation, that is operation tax, right? Total operation cost, right? So after this calculation, now there is 9%. That is, like, I can say, EBITDA, right? Earning before interest, tax, and depreciation.
Brilliant. Yes, that's earning before. Yes, EBIT. Yes, you're right. Earning before interest and tax. Yes, it can be after interest and tax as well. Yes, so we can calculate both. Yes. So after tax one, we pay dividend. Yes, because we pay dividend after tax.
Yeah,
Okay, so we can look around the 3220 divided by divided by 28,000. Yes, and times by 100. So that's coming 11.5. Yes.
Yeah, 7.5.
So they have 11.5 and they have a 9. So still Paprika is a better than Anika. So what we can do, we can fill these sheets. Yes.
Yeah.
We can fill this template. Yes, we have all the formulas.
Yeah.
But we can. So next lesson I'll go through more in, and we can discuss. So all the formulas. If we need now, so if we'll go to now, this is the balance sheet. We have a current asset divided by liability. So current asset 7123. Yes.
Okay. Yeah.
We can check the liquidity ratio 7123 divided by current liability
3876.
7 is 1.83. It
The ratio is
means every 1 pound of liability, I have 1 pound 87, or we can say 84 pence of asset, which is still good. Yes, which is more than 1.
Yeah.
Any question?
Can you just explain me a little more about the overdraft, this bank overdraft? It is means like in the bank, the overdraft means like whatever I have remaining, it is, right?
No. Overdraft mean the bank normally authorize a limit. You can use their money up to certain level, and I'm using their money for short period of time. Like, maybe I receive a money after 30 days from customer, but 30 days I'm using their money. So that's a short period of time. That's called overdraft arrangement, which normally arrangement in place, agreement your account, especially maybe I'm not sure about other countries' banking system, but in the UK we have almost every account. If your credit scoring is good, bank give you some overdraft.
Okay.
So if my salary is few days late, so I can use overdraft, and the bank can charge me overdraft fees for suppose £2 a day, and up to that limit, maybe they give me £2,000, the overdraft limit £10,000 overdraft. Companies can be 50,000, 100,000, depends. Yes.
Same like I can say like a credit card, they increase the amount of the credit card, something like that, right?
Yes, it's quite similar sort of, because the credit card is their money as well, is on credit, and the overdraft is also credit.
Okay.
Okay, so we can use these ratios. These current asset, current liability come under the liquidity ratios. Okay. So if I'll go back to the attempt, so it's better to use few ratios. So under P, you calculate few ratios. Under gearing, you can calculate one or two. Gearing is mean debt. Debt is come under liabilities plus investment equities. So we can interest cover is a finance cost divided by then the liquidity ratios I just mentioned. Yes, current asset.
Yeah.
This
Yeah.
current asset divided by current liability. So if you do two ratios until next, we'll send you these handouts. Yes. So next lesson we can complete. Yes, we can go through more ratios as well, and then we can realize even in the next discuss the budget. We can do the half lesson more ratios.
Yeah.
And then we'll go through next 3. Yeah. Any question?
Okay. So far, no questions right here.
Of my slides, you will see all the formulas there. Huh?
Yeah.
So all the information you can look around two statements: income statement and profit and loss. Statement and balance sheet, and you can find all these figures. Huh? And just by using normal formula, and we can calculate. Yes.
Yeah.
So you have a template as well, which I'll send you normal this data with the answers as well. Yes.
Okay.
All the answers, so you can play with it. If you want to go through the company statement, and I copied few company statement link as well.
Okay.
Like if you want to go UK, in the UK we have Tesco and Morrison. These are supermarkets, fashion business, so we can use there too, and we can compare. Are the world famous company Unilever and Procter and Gamble. Yes, so we may be aware of it. Used to call Lever Brother or Unilever in India, or Unilever in other country also called as well, which is the same company, and Procter and Gamble as well. So we can click by that, we can download their financial copy, and you can download their statements as well.
Okay.
And if you want to exactly the same, you want to go through these companies comments, you can write the company and you can go through these ratios. Yes. And all formulas
I can get any data from anywhere, right? But I just need to do the ratio analysis.
Yes, basically that's all. And then we can explain what happened this year, that year. Yes.
Okay. Yeah.
And all these been explained in these tasks as well, which are the answers for these tasks. So you go through. It means you know almost everything then. When you do go through at least one question.
Okay.
Like this is the statements we have all, and then we've been given the information, we've been asked, use the formulas 5 ratios, you calculate 5 ratios, you calculate these ratios for both company, and you comment them. Yes, what's happened, all been answered. So in exactly the same way we can do for assignment purposes as well. Huh? We can pick any other company and we can argue.
Okay. Okay.
I copied the quiz as well. If you want to play with it. So this is the quiz. You can copy the link and you can play with it. What is financial ratio? Yes. And at the end of the quiz, you will get all the answers as well. And you can review.
Okay.
Any question?
When I do the analysis, I just need to do the analysis, like I need to compare like for like, right?
It's
Like let's say 2019 to 2018.
Yes, you can go through 2018 and 19, or if you can't find 2018 and 19, you go through 2018 and 2017. Yes, 2 years. Always good to be compared 2 years. Yes.
Yeah. Yeah.
Or I can go 2018 for one company, 2018 for other company, but always need to be good to be a company size is the same size, because one big company, one small company is no comparison.
There is no comparison. So same or maybe only like a 2017 to 2018, right?
Yes. Or you
Okay.
do one company of 2 years, huh? Which is fine.
Yeah. Yeah.
So that's all today. So today we discuss about what is meant by financial ratios, how many types of financial ratios, how many types of financial statement repair. We discuss, just in time. We discuss liquidity ratio and we'll analyze them.
Yeah.
By looking. So that's all today. Any questions?
That's all. This assignment, when I have to complete?
When we'll finish is 2 weeks, afterwards.
Okay.
So normally we keep, but next lesson I'll go through a bit, recap.
Okay. So like next week, one more session, and after only we have to do it, right? Or I can try now for the ratio because the ratio is finished already.
No problem. You try ratios and try it. I'll go through the assignment brief.
Okay. Sure.
Can go through one extra lesson as well.
Okay. Sure.
Okay, everyone. Any questions? Anyone? Please just drop me emails. Today we discuss about LO2, the working capital, which means the working capital, where we discuss about the current assets, current liabilities. We'll calculate all these ratios to measure the performance, and please ratios the relationship between two things. And that's all today. If any questions, just drop me email. I'll get back to you. Okay, please. I'll send you the template as well. This is the template which you use to prepare and calculate ratios, all the formulas at the side. And if you have any questions, still emails, I'll get back to you as soon as possible. I hope so. All will speak you, and any question, just drop me email. Thanks. Bye bye.